What's going on, superstars? It's 𝗧𝗵𝗍𝗶 here again, and I'm super excited to be back to YouTube and more excited to bring you guys another tutorial video on my trading strategies. One of my top performing video from 2 years ago, that is 2022, has actually been making a lot of impact, and that has to do with my Volatility 75 sniper entry video. And recently in 2024, I see a lot of new subscribers coming to the YouTube channel and have been getting massive value from that particular video, and I have actually decided to even give you more premium information as regarding trading strategies and also trading techniques, so that you all can improve on your trading journey. If you're new to this channel, hit the subscribe button, and if you enjoy this video while you're watching, make sure you give it a thumbs up and also comment your name and where you're watching from. So in this video, I'm going to show you how I trade Volatility 51s and the strategy that I use that allows me to catch hundreds of pips in few minutes. As you can see in our Telegram channel, we have several successful trade setups that have been taken on this particular instrument, and you can also see the feedback from our students, those who have been taking our trade setups in the Telegram community. So if you want to get the best from this video, I strongly recommend that you pay a very close attention to every detail, because in trading, if you can see it, you can have it. And the best way you can actually see things is by paying close attention to what other successful traders are actually doing, so that you can have a roadmap of what you should emulate to get your own result as a trader. Without further ado, let's get started. Now, the first thing that you got to do to become a successful trader that is catching a lot of pips trading volatility indices like Volatility 51s is to have mastery of top-down analysis. Top-down analysis has to do with starting from a higher time frame and stepping down into a smaller time frame, like starting from the daily time frame and stepping down into the 1 minute time frame. Now, to achieve this, I would be doing my analysis on TradingView implementation for DERIV. I know a lot of you are going to be asking, how do we get this on TradingView? It's simple. All you need to do is to visit charts.deriv.com. I'm going to put that on the screen, charts.deriv.com. That will take you to the website where you can do all of this analysis. And also take note, when you get to the website, you may find it difficult to actually find out this instrument, because if you type Volatility 75 1s or Volatility 51s, right, it's most likely not going to give you any data. You can see no symbol found. So the way you can do it is use the codes. There are codes that are assigned to this instrument. So for volatility indices, especially Volatility 51s and the 1s series, you can see the code is 1HZ50V. So if you just type a 1 here, you're going to see the list of all the 1s series. And if you want to look for volatility indices like Volatility 75, you may just look for the R. The Volatility 75 index, you have R_75 to find Volatility 75. But in this video, we're just going to be paying attention to Volatility 51s, and we'll be sticking to the strategies used for trading this. So the first thing you got to do is top-down analysis. Therefore, you want to look at the market on the daily time frame. And when you see the chart on the daily time frame, what is the particular thing you got to identify as a trader? I teach my students to pay attention to candlestick patterns. You need to define what kind of candlestick you are seeing the market create. For example, this buy signal that you see running on Volatility 51s on the daily time frame right now, that has done over, let's see, has done over 1,700 pips. You can see part of the reasons why we executed this buy is because price created a 𝗖𝗵𝗍𝗶𝗵𝗺 pattern, which is a bullish 𝗖𝗵𝗍𝗶𝗵𝗺 pattern here with these two candlesticks. Let me zoom in so that you guys can see clearly the bullish 𝗖𝗵𝗍𝗶𝗵𝗺 pattern. And you can see that the entry was at the beginning of the next day. The next day, that is where we had the entry, and we had the stop loss here. So in a nutshell, you need price to create the candlestick pattern before you execute. Another thing that you need to pay attention as regarding candlestick patterns is the highs and the lows of the candles. It helps you to know what direction the market is going to. Now, in the aspect of top-down analysis, after you've identified the highs and the lows of the previous day, and also you have identified the candlestick patterns that are being created, the next thing you want to do is to identify the zones. You want to easily go into the 4-hour time frame to actually map out those zones. They are called price reversal zones. They are easy to identify. Price reversal zones are areas on the charts where price has actually given us reversal in time past. And these price reversal zones could be seen as supply and demand. They could be seen as support and resistance. They could be seen as order block, which is one of the popular strategies that we actually use in our community. The order block is got from the engulfing candlestick pattern. So once you identify these price reversal zones, you have actually given yourself a scope, or you've given yourself a heads up on where you should be looking out to play to your entries. And if you know the appropriate structure of the market, it places you at an edge to actually maximize your profits when you're trading. And with that said, that takes us to the next thing you need to know as a trader, and that is called market structure. In trading, there are three types of market structure, which is the trending market, the choppy market, and also the ranging market. In all these three, the best market for you to trade is the trending market. And why the trending market? Because the trending market gives you a regular pattern and it shows you a sense of direction. In the trending market, we have the uptrending market and we'll also have the downtrending market. So I'm just going to show you quickly how an uptrending market structure looks like. So if price is maintaining an uptrend, you're going to see it looking like this: an impulse, correction, and then impulse. All right. Or you can refer to it as impulse, retracement, and on impulse, and so on. Now, for you to enter a buy, especially when the market is going up, you want to look out for where price is going to give you completion of a retracement. After the retracement is completed, then it gives you a clue on where to enter. When the retracement is over, you want to look out for an entry to continue in the direction of the trend. It's as easy as that. For a downtrending market, we'll also get the impulse and also the correction in this way: an impulse, a correction, an impulse, a correction, and then an impulse. So this is how the downtrending market actually looks. However, in this market, as we can see, the market is currently in an uptrending market, and that is why I consider this market as a good market to trade even within the next couple of days, because price is giving us a very good trending market. And the best thing you want to do as a trader is to make sure that you trade according to the trend and not against the trend. Because if you're trading against the trend, you're going to catch relatively a smaller quantity of pips than how much you're going to catch if you're following the trend. There's something else I want you to take note of. In this 4-hour time frame, as you can see, even though we have a swing setup that is running onto the top, I'm just going to close this out and we're going to visit it again. I'm just going to delete this. Now, as you can see on this particular setup, you see that there's an engulfing candlestick pattern here, and that makes this area quite some area of the chart where one wants to consider that, hey, there's most likely going to be a potential for price to actually reverse around here. And that is the thing. Now, after you have identified a zone like this, just like I said earlier, where you got to identify a price reversal zone, it's important that you note that you're not just going to see that zone and you execute a sell or a buy or something like that and you just jump on the market like that. No, you don't want to do that, okay? You really do not want to do that. So what you want to do is to step down in the time frames and see the opportunities in a better and well-detailed format. And that will take us to identifying the market condition, current market condition, on the 5-minute chart. I usually use the 5-minute chart and also the 1-minute charts to identify my sniper entry positions whenever I am trading. Now, whenever you are actually trading and you see patterns like this form in the chart, make sure you follow some certain rules. I could refer to those rules as my confirmation checklist. So let's take a look at this market real quick. As you see that price is rallying to this top side here and has gotten in here, we see the price was creating some kind of pattern. And that takes us to the next chapter on this: chart pattern. You need to learn how to identify the chart patterns, because chart patterns help us to interpret what the candlesticks are actually saying. The candlesticks, they are like words. When they are put together, they create chart patterns. And these chart patterns could be referred to as sentences on the market. Now, when the chart pattern has formed, it's expedient of you to learn to identify where the pattern is going to be leading to. We can see the price created an ascending triangle here. And after the ascending triangle has been formed, what happened? We got a breakout of the market to the top side. However, if you look in time past, there was a false breakout of the market in the triangle pattern here. You see price broke out falsely and rallied back up, showing us that there's a stronger momentum for buys than sells. If it respected this, it would definitely just dump to the downside. I want you to take note of this. After you have identified the chart patterns, it's also important that you pay attention to some other conferences, like the conference that I actually use in my trading. and the confluence refers to divergence and convergence. So I'm going to talk about divergence and convergence really quick. Before I get there, if you've not subscribed to the channel yet, hit the subscribe button, give this video a thumbs up, and also comment where you're watching this video from. So let's go into divergence and convergence really quick. There's an indicator that I use for that, and it's called the MACD. So I'm going to introduce the MACD on the default settings. Now, if the market is giving us higher highs and the MACD is giving us lower highs, it is called divergence. Or for example, if the market is giving us lower lows and the MACD is giving us higher lows, then it is called convergence. So in cases like this, you want to add this not as the first confluence, but most likely like the third confluence before you execute, because after you've identified the pattern of the market, you've identified the zones, then the next thing is, oh, do I see divergence or convergence? It helps to add to your confirmations. Now, before you shoot, make sure that price gives us a well enough breakout, then finally a retest. As you can see in this market, there was a breakout, but price came back up into the zone and definitely going even above. But this gives me a further clue that price is simply trying to exhaust all the buy positions, and after it has exhausted it, it's going to go down. Now, this will take us to the next point on this video, which has to do with your stop loss and your take profit. Any strategy that you're trading with that does not show you where to place your stop loss or your take profit, you want to be aware of it and you want to run away from it. Yes, because no strategy or no setup is 100%. Every setup could be 90%, 95%, but there's always this 1% that could just go gaga, right? So you don't want to lose the whole of your account trading just that 1% after you've grown your account over time. So what you want to do is make sure you identify a proper setup and you identify your stop loss whenever you're trading, and you're sure that if the market goes against you, you're not going to be losing the whole of your account. So to set your stop loss, ensure that you identify that zone and put your stop loss in a significant level above it. So let's say in this market now, since I can see there's an engulfing candlestick pattern, I could literally just execute a sell anywhere around here when the confluence is confirmed, and then I look for a potential take profits down to this particular point if price is going to go down there. But before I shoot for this sell, I'll definitely want to wait for further movement of price. I have seen divergence taking place, so I want to see price start giving us a bear movement already. Price has to start giving us a bear movement before we go downwards. Now, another thing you need to take note as a trader is where to take profit, because you don't want to get to the river and come back without water. To identify your take profit levels is very easy. Just look at the previous sides of the market where price has reversed. Like for example, there's a support here, and this support doubles with this resistance to be more like a pivot zone around here. So I'm going to want to put a profit here, and also I'm going to want to put another profit. I want to take some take profit here, around here, somewhere around here, because this is some form of a resistance. So this is another thing that you have to look out for when you're taking your positions. As a sell position in this case would be, if I was going to execute a sell here after my confluence has been confirmed, this is what I'm going to do. I'm going to make sure that I give the price enough room that is above that order block zone, and I want to take some profit around this particular level. So this makes it really easy. But before you can maximize your profits when trading volatility 51S, you want to make sure that you know how to calculate pips on the volatility 51S. Now, there's a simple ideology or a simple method that I use for calculating pips when we talk about volatility indices. As you can see, the quote of volatility 51S has 6 digits before the decimal point, and it has just 2 digits after the decimal point. That means it is quoted in 2 decimal places. For all volatility indices, the P position is the second to last digit before the decimal point. So if you want to calculate how many pips price is displaced whenever you are taking a trade setup, you have to start from this number. That is your pip position. Okay, so if price travels, let me just label this as the pip. So if price travels from this number 89 to 90, then it means that price has traveled by 1 pip. If price travels from 89 to 99, then it has traveled by 10 pips. So once you understand how these pips are actually done, it helps you to know how much you're going to be risking on your trade setup. In order not to make this video too long, I'm going to create another video that explains how to calculate pips on volatility indices. Now, if you want to watch that video as soon as it gets dropped, make sure you subscribe to this channel, and also you like this video. And don't forget to comment where you're watching from, because I want to know all of my subscribers. If you want to get our free trade signals and you want to stay updated with all our trading updates, ensure you join our Telegram channel. Check the description of this video to see the link to join the Telegram channel. I'm going to be looking forward to see you on my next video. Remember, nothing can stop you. You're all the way up. So keep showing up until your dreams come true. Thank you for watching. My name is 𝗓𝗵𝗍𝗶𝗵, and I'm always here to help.